Hello everyone, this is Payal Bhagat and I am here again to continue chapter 5 of accounts, that is admission of a partner. In the previous video, we have gone through the introduction and I have also explained necessary content of theory. So moving ahead, let us first of all talk about the weightage of this chapter, which is of 9 marks, of which is one VSQ and one long question of 8 marks. While going through textbook, you can see they have also given various short sums, of which one I have explained in the previous video. These sums need not be separately understood as they can be learned along with long sums. You can see there are a lot of short sums, they are also presented in exercise. Moreover, these short sums are converted in the form of various adjustments presented in long sums. Hence, they can be well understood while solving a long sum instead of learning it separately, which will also help us save our time. Let me also highlight a point here that short sums are not separately asked anywhere in your question paper. So moving ahead, let me now make you aware of general assumptions for solving a long sum. There will be two partners in a partnership firm in consideration to the questions given in your textbook. A new partner will be admitted in this firm. A new partner will bring the amount of capital and also amount of goodwill. You can see here accounting treatment of goodwill as per accounting standard 26. They have presented various concepts of goodwill in this chapter. Here they have presented the concept of goodwill in different form of journal entries, for which I will be making a separate video and I'll be explaining this concept in detail. For now, while solving a long sum, I'll also explain the concept of goodwill along with these long sums, as the concept of goodwill is given in the adjustments presented in long sums. Short sums regarding goodwill are also given here. Again, they are not asked separately anywhere in your examination. So, we'll focus on solving a long sum. So, quickly moving to illustration 18, which is a long sum of this chapter that I have taken for today. Now, finally moving towards a long sum, let us start with illustration 18. You can see here the concept of revaluation of assets and liabilities is also given here, which we have already learned in chapter 4. And it is very important to understand this concept before jumping towards chapter 5. So, if you are not aware regarding the accounting effects of revaluation, you need to go through chapter 4 first and then only you can solve this sum. Okay, finally, we are here with illustration 18. Starting with this sum, let me first of all highlight how is the question presented. You'll be provided with the balance sheet of the partners, that is the old balance sheet. You will be supposed to prepare a new balance sheet after giving effects for various adjustments, and I can say after the admission of a new partner and after various changes. So let me read this question for you. Patel and Shah are partners in a firm sharing profit and loss in the ratio of 3:2. This is the old ratio of partners. The balance sheet of their firm as on 31st/3/16 was as under. This is the position of the assets and liabilities of the firm of Patel and Shah. Further, you can see the new partner, that is Raval, who is admitted, is given 1/5 share of profit, and the partner brings rupees 2 lakh as his capital. Let me be clear here. Whenever the new partner is admitted in the firm, the partner is supposed to bring the amount of goodwill and the amount of capital. Now you are supposed to follow several steps for solving a long sum. First of all, you need to carefully read the entire question, very carefully. Then you are supposed to draw the necessary accounts as in revaluation account, partner's capital accounts, cash and bank account, and finally a new balance sheet. If your sum contains that you are even supposed to prepare the journal entries, then the serial number goes somewhat like this. First of all, you'll be writing journal entries. You'll prepare a format for journal. Then revaluation, partner's capital accounts. Partner's capital accounts has an option. If the balance of current accounts is given in the given question is, old balance sheet, then you are supposed to prepare partner's current account instead of preparing partner's capital account. Further, cash and bank account. Now, another point here is, if cash balance or bank balance is not presented, if it is not given in the old balance sheet, then it is not necessary for you to prepare cash account. You can also prepare, there is no issue. But all I want to say is that if you are not preparing it separately, then it's well and good. So first of all, I can see here the balance of capital accounts of partners is given. Balance of current accounts is not mentioned anywhere. So my sum will contain revaluation, partner's capital, cash and bank, and balance sheet. I can see here the balance of cash and bank is not separately given. So it's okay if I want to skip preparing cash and bank account. Finally, moving towards the adjustments. As I said, you need to carefully read the entire question. We have gone through the question. There are two partners. Their old profit and loss sharing ratio is 3:2. Their balance sheet is given as under. The partner will be given 1/5 share in profit. The partner will bring 2 lakh as capital, and the partners decided to revalue assets and liabilities as follows. So this is the concept of revaluation of assets and liabilities. That is the change in the value of assets and liabilities. This concept is given in a detailed form in chapter 4. So overall, there are 10 adjustments, of which 6 are given here, and half of them I can see here. So overall, there are 10 adjustments. Now they have instructed what we are supposed to prepare with regard of this sum. Give necessary journal entries. I am reading after adjustment 10. I repeat, give necessary journal entries, prepare revaluation account, partners' capital accounts, and balance sheet after admission. For today, we are going to learn about journal entries, and I will explain how to prepare ledger accounts in the next video. So for today, we are going to learn how to write journal entries of this sum. Okay, moving back to the balance sheet of this question and the adjustments, various adjustments. First of all, you need to prepare the format for journal entries, and I will read all the adjustments one by one. Okay, the very first adjustment, which is land and building is to be appreciated by 20%. Now let me explain what does this mean. First of all, land and building is our asset. So whenever the value of an asset increases, it is in the benefit of the firm. So the rule that whenever a firm is benefited, revaluation account is credited and vice versa. That means whenever a firm is making loss, revaluation account is to be debited. So all I can conclude is that the value of land and building here is increasing by 20% compared to the value which is given in old balance sheet, which is said as book value. The value presented, or else the value given in balance sheet, is the book value of an asset or liabilities. So the book value of land and building is 1,40,000, which is to be increased, appreciated is increased by 20%. So 1,40,000 into 20 by 100. 14 twos are 28. So 28,000. Value of land and building is increased by 28,000. So the journal entry for this, I repeat, whenever the value of an asset increases, revaluation account is to be credited and we are going to debit the respective asset account. So you can see here, let us move to the journal entries. Here I can see land and building account debit, asset is always debited, and also the value of an asset has increased here. So land and building account debit 28,000 to revaluation account 28,000. Revaluation account has been credited because the value of an asset has increased. Moving towards the second adjustment, quickly, machinery is to be depreciated by 10%. Depreciated is just opposite to appreciated. Now let us check the value of machine, which is 70,000. Book value of machine is rupees 70,000, which is depreciated, that is decreased by 10%. So 10% of 70,000 is 7,000. The situation is opposite compared to the first adjustment. First adjustment says that the value of an asset increases, and the second adjustment says that machine, an asset, the value of which decreases by 10%. So let us see the journal entry. This is a loss. So revaluation account will be debited, of course, and the value of an asset has decreased. That is the reason the asset has been credited by 7,000. Here, another point to be noted is that what is the new value of machine now? That is 70,000 minus 7,000, which is 63,000. Yes. Now moving towards third adjustment. Furniture is valued at 60,000. Understand what they are trying to say. Book value of furniture. Here in the balance sheet, it is 80,000, I can see. And in the adjustment, they say now furniture is valued at 60,000. Understand the meaning. Furniture was of rupees 80,000 and now it is of 60,000. So all I can interpret here is that the value of furniture has decreased by 20,000 rupees, old value of furniture is 80,000 and the new value is 60,000. So the value of furniture has decreased by rupees 20,000. Again, here the value of an asset decreases. So let us check the journal entry. Yes, revaluation account debit to furniture account. Here the value of an asset decreases, hence the respective asset has been credited and revaluation account has been debited. Next, motor car is to be depreciated by 20%. I hope you all are able to understand what do they mean. Motor car again is an asset, the value of which is to be decreased. Depreciated is the value of an asset is to be decreased by 20%. The old value of motor car is 1,20,000, 20% of which is 24,000. Let us quickly check the journal entry. Yeah, revaluation account debit to motor car account, 24,000. Moving towards the next adjustment. These are all really very simple adjustments. We've already learned them in chapter 4 while learning the concept of revaluation account, and we have also solved the sums given in the exercise. So it is nothing, just the repeated part. And another point that you are supposed to remember here is that chapter 6, the very next chapter to this, is completely identical. Even in that chapter you are supposed to prepare the same accounts. There are only minor changes, as in here a partner is admitted, there the partner retires. So except for some changes, the entire sum remains same. So it is better that you well understand this chapter here, so that you don't have to learn it again and again in chapter 6. In chapter 6 you will only learn the new concepts. Okay, coming back to the adjustments. Yes, we have reached to adjustment 5. Yeah. A provision for doubtful date is to be kept at rupees 5,000. Provision for doubtful date is bad date reserve. You are supposed to create a provision of rupees 5,000 on daters. Let us check the book value of daters. Yes, I'll consider the value which is given in the inner column, which is 21,000, and of which 1,000 is bad date reserve already, and I am supposed to keep a bad date reserve of 5,000, and 1,000 I already have. So how much more is needed? 4,000 rupees. So the journal entry, bad date reserve. If you remember the specimen journal entries of chapter 4, the journal entry for this is revaluation account debit to bad date reserve account. Let us quickly check the journal entry. Yes, I can see here revaluation account debit to bad date reserve account, 4,000. What are they trying to say is that we are supposed to keep a bad date reserve of rupees 5,000, of which 1,000, here I can see 1,000 is already given, and 4,000 more is needed to make it 5,000. Fine. We'll continue. Adjustment number 6. Patents are valueless. Patents is an intangible asset. It has no value now. Let me check its old value. 10,000. Now it is completely valueless. So it is a complete loss. 10,000 loss. So the journal entry, whenever it is a loss, revaluation account debit to respective asset. Let us check the journal entry again. Yes, I can see here. Revaluation account debit to patents account, 10,000. There is no value of patents, so there is a loss of complete 10,000. So there is no new value even of patents to be presented in balance sheet. Fine. Moving ahead, I have adjustments here. Seventh adjustment, as you all can see. Outstanding interest on loan is rupees 6,000. First of all, outstanding interest on loan is what? The amount of interest that I am supposed to pay. So necessarily it is my expense. So at the time of expense, revaluation account is debited. Secondly, this is our liability. Let us quickly check the journal entry for this. Yes, I can see here. Revaluation account debit to outstanding interest on loan account. 6,000. I repeat, interest on loan is my expense. That is the reason revaluation account has been debited here. Moving towards the next adjustment. Creditors and bills payable are to be paid 10% less. Creditors and bills payable are my liabilities. Now, I am supposed to pay my liabilities less by 10%. So you are supposed to think here that it is my benefit or is my loss. Of course, it is my benefit because I am supposed to pay less comparatively what I was supposed to pay. So this is my benefit and hence revaluation account will be credited. Let us quickly check. We'll check the book value of creditors and bills payable first of all in the balance sheet. Yeah, creditors 80,000, bills payable 20,000. 10% of each 8,000 and 2,000 respectively. Moving towards the journal entry. Yes, I can see here. Revaluation account debit. Sorry, mistaken. I think the journal entries for this we cannot find here. So I will dictate it for you. Yes, I can dictate it well. There is a mixture of the content. Please pardon for that. Yes, so I was talking about that we are supposed to pay the liabilities less by 10%. So the journal entry for that goes somewhat like this. If you are having a textbook with you, you can check in that. The journal entry will be creditors account debit 8,000, bills payable account debit 2,000 to revaluation account 10,000. Fine. Moving towards the next adjustment. Unrecorded investment is valued rupees 20,000. Unrecorded investment. First of all, investment is an asset. It was not recorded. Now its value is 20,000. So definitely this is an increase in the assets. This is obviously the benefit. So revaluation account will be credited here. Investment account debit to revaluation account. Let me check if I can find the journal entries here. Yes, we have these journal entries. Pardon for the inconvenience. The previous journal entry that I have dictated, you can check it here. Creditors, bills payable 8,000, 2,000 and revaluation 10,000. Talking about investment account, it is valued at 20,000. Investment account debit to revaluation account 20,000. Fine. Moving ahead. Yeah. Insurance premium which was debited to profit and loss account by rupees 30,000. Out of this, 10,000 is for next year. If you all have learned this concept in final accounts, you can interpret that this is a prepaid insurance premium. So prepaid insurance premium, during this time revaluation account is credited because the premium has been paid for the next year during a current year. Let us quickly check. We'll be quickly checking the journal entry. Yes, I can see here. Prepaid insurance premium account debit to revaluation account, that is 10,000. insurance premium of 10,000 is prepaid, which is for next year. So revaluation account has been credited. The very next journal entry that is presented here can be written after doing all the adjustments and posting them in revaluation account and balancing the same. So this journal entry we are not supposed to understand for now. I will definitely make you understand in the next video when we'll finish preparing all the ledger accounts and also the journal entry below that. So we are done with the journal entries of all the adjustments. And I repeat, the last two journal entries, I can explain the last journal entry. We have already read the content. This is the new partner bringing the amount of capital, which is 2 lakh. So cash comes in. So cash account is debited as per the rule of real account. Cash account debit 2 lakh to Raval's capital account. Raval is the new partner admitted in the firm. So the second last journal entry, it can be understood only after preparing the ledger accounts, and hence I'll explain this journal entry while I'll finish explaining all the ledger accounts in the next video. So that's all for today. I hope today's video was helpful for you, and in case you have any problems or doubts regarding the same, you can write in the comment section given below. I will be back soon with the same chapter. Till then, stay home and stay safe.